You think the artificial intelligence boom is a straight line to infinite profits? But Washington may be turning the global semiconductor trade into a political choke point. We start with reports that the United States is weighing a broader licensing framework for global AI chip exports. Then we look at Broadcom's $10 billion buyback after another strong quarter. Next, we track the geopolitical risk premium driving oil sharply higher. We finish with Oracle reportedly planning major job cuts as AI infrastructure spending pressures corporate budgets. Stick around to see how these forces could reshape margins, capital spending, and portfolio cash flow. Washington is reportedly considering a wider prior licensing system for advanced AI chip sales overseas. That is not the same thing as a fully implemented global mandate yet, but if adopted, it would extend U.S. control deeper into worldwide AI infrastructure flows. For companies like Nvidia, that means lower revenue visibility and more policy risk around international shipments, especially involving China. And when visibility falls, investors usually demand a higher risk premium, which can pressure semiconductor valuation multiples and future capital spending plans. Amid that uncertainty, Broadcom just delivered an earnings beat and reaffirmed the market's appetite for AI-linked cash generation. The company also highlighted expectations for more than $100 billion in AI chip revenue next year and announced a new $10 billion share repurchase plan through year-end. Investors can read that buyback in two ways, as confidence in future cash flow, or as a signal that management wants to support shareholder returns while the policy backdrop grows more unpredictable. The confirmed fact is the buyback. The more defensive interpretation is possible, but it is still interpretation. The physical cost of the AI boom is also starting to show up more clearly in enterprise balance sheets. Oracle is reportedly planning thousands of job cuts as the cost of building data center capacity rises. That does not prove its balance sheet is breaking, but it does suggest that funding AI infrastructure is becoming expensive enough to force difficult operating decisions. If more companies face the same pressure, investors may have to rethink how quickly AI revenue can scale relative to the capital required to build it. Meanwhile, energy is becoming another source of stress. Oil prices have surged as the conflict involving Iran, the U.S., and Israel has disrupted regional shipping and damaged tanker traffic in the Strait of Hormuz. Reuters reported Brent touched its highest level since July 2024 earlier this week, while analysts warned that a prolonged disruption could fuel inflation and hit global growth. That matters because higher crude feeds directly into transport, manufacturing, and input costs across the economy, putting fresh pressure on corporate margins. Tomorrow, keep a close eye on the U.S. Employment Situation Report for February 2026, scheduled for Friday, March 6th at 8:30 a.m. Eastern Time. Watch whether payroll growth and unemployment suggest the labor market is still holding up while inflation risks rise again through energy. And keep watching semiconductor names and chip ETFs to see whether the market starts pricing in a more restrictive export regime instead of treating it as background noise. This is not financial advice. Keep your eyes on the margins. I'm Wilson, and I'll see you tomorrow.